Financial statements. Financial statements reflect the activity and financial condition of a company. The most important financial statements discussed in this section are balance sheets, income statements, and statements of cash flow. Balance sheets. These show the financial position of a firm on a particular date in terms of its assets, liabilities and owner's equity. It shows a firm's financial condition at one point in time. So, you can think of balance sheet as like a picture which capture one point in time. Assets. Assets are what the company owns. 3 types of assets are listed on the balance sheet, usually in order of decreasing liquidity, the ease with which they can be converted into cash. Current assets. These include cash, money in the bank, and assets that can be converted into cash within the year. Fixed assets. These include land and buildings. Intangible assets. These include the cost of obtaining rights or privileges such as patents, trademarks, copyrights, franchise fees, and goodwill. Liabilities. Liabilities are what the company owes. Current liabilities are debts owed by the firm that must be repaid within 1 year, that is accounts payable. Long-term liabilities are debts owed by the firm and due in more than 1 year. Owner's equity. Owes what the owners of the company own. This includes the common stock, paid in capital and retained earnings. Here is an example of balance sheet. Income statements. These are also called profit and loss statements because they describe financial position in terms of the equation. Revenues minus expenses equals profit, or loss. The income statement, unlike the balance sheet, covers a period of time. Revenues. Monies received by a firm as a result of selling a good or service or from other sources, for example, interest, rent, etc. Cost of goods sold. Any expense directly involved in producing or selling a good or service during a given period. Gross profit, gross margin. This is calculated by subtracting the cost of goods sold, COGS, from revenue. Operating expenses. Costs that are incurred by a firm other than those included in the COGS. Operating income and net income. Operating income compares the gross profit from business operations against operating expenses. Net income is calculated by subtracting income taxes from operating income. C. Statements of cash flows. These describe a company's cash receipts and cash payments for the year. It is particularly useful to investors and creditors as a summary of the firm's ability to generate and use cash. A statement of cash flows shows the effects on cash of the business's operations, investing, and financing. 3 areas are cash flows from operations, cash transactions in buying and selling goods and services, cash flows from investing, cash used in or provided by investing, and cash flows from financing, the net cash from all financing activities including inflows, from borrowing, issuing stock, and outflows, payments of dividends, repayment of borrowings. Revenue recognition and matching. Revenues are recorded for the accounting period in which sales are completed and collectible. The matching principle states that expenses will be matched with revenues to determine net income for an accounting period. The budget, an internal financial statement. This detailed statement of estimated receipts and expenditures for a period of time in the future, usually a year, is an important planning device. Its preparation is technical and time-consuming, requiring input from many. Analyzing financial statements. Using the information provided in financial statements to make decisions, for example, extending credit, investing, is aided by using statistics and ratios to compare financial statements across companies and in time, past versus current. The key ratios and their uses are described. Solvency ratios, borrower's ability to repay debt, Lenders want to know the likelihood that a borrower will be able to repay a loan and the interest that is due. Short-term solvency ratios. These ratios measure a company's liquidity and its ability to pay immediate debts. The current ratio measures the ability of the firm to meet its current obligations out of its current assets. Long-term solvency ratios. These ratios include the debt-to-owner's equity ratio, which describes the extent to which a firm is financed through borrowing. Profitability ratios. Earning power for owners. Investors are particularly interested in what returns they can expect from their investment. 1. Return on equity. This ratio shows how much net income a business earns from each dollar that was invested. It is computed by dividing net income by total owner's equity. 2. Return on sales. This ratio shows how much profit each dollar of sales generates. It is computed by dividing net income by sales revenue. 3. Earnings per share. This ratio shows how large a dividend a company can pay its shareholders and indicates how much a company can reinvest in itself instead of paying dividends. It is computed by dividing net income by the number of shares of common stock that are outstanding. Activity ratios. How efficiently is the firm using its resources? The most widely used activity ratio is the inventory turnover ratio, which indicates the number of times inventory is sold and restocked during the year. Higher ratios indicate greater efficiency. Bringing ethics into the accounting equation. The ultimate purpose of strong ethical standards in accounting is to maintain public confidence in business institutions, financial markets, and the products and services of the accounting profession. Without ethics, all accounting tools and methods would be meaningless because their usefulness depends, ultimately, on their honest application. Many managers have demonstrated poor judgment and have experienced ethical lapses with regard to accounting issues. In some cases, this led to the demise of the company they worked for. Ethics remains an area where one person who is willing to do the right thing can make a difference. The evolving role of the modern accountant. Lessons from the global recession, along with evolving information technologies, are among the prominent forces shaping the future for accounting professionals. The expectations for modern CPAs call for the more intimate role of leadership in demonstrating financial implications for many additional facets of the business, including its overall operations, strategy, data management, human resources, and technical resources.